The US dollar has lost approximately 97% of its purchasing power since the Federal Reserve was established in 1913. To match the buying power of $1 back then, you would need over $30 today. Even more recently, a dollar held in cash since January 2020 buys about 78 cents worth of goods right now. This rapid drop in value has people across the internet asking a very specific question: is the US dollar actually a Ponzi scheme? Most financial advice either laughs this off completely or tells you the entire system is collapsing. Neither is helpful, and neither is accurate. Answering this requires looking at measurable, documented government data rather than internet theories. To understand what is actually happening to your money, we have to define inflation. It is a decrease in the purchasing power of a currency, which happens when there is an increase in the money supply combined with a decrease in available goods. During 2020, the M2 money supply, the broadest measure of currency in circulation, grew by 19%. More dollars existed, but fewer goods were available due to global supply chain breakdowns, causing prices to rise. While inflation runs at 3.8%, average savings accounts pay 0.38%. Over 10 years, a $10,000 balance grows nominally, but actual buying power shrinks, buying what $8,200 bought a decade prior. Roughly 4 in 5 Americans are keeping their money in these traditional accounts. Their balances go up slightly, while their purchasing power goes down silently. It feels like a scam, but it is a thoroughly documented mathematical problem. A Ponzi scheme relies on paying early investors with new money through deception. By that strict definition, the US dollar does not fit the model. Instead, the currency is backed by the output of the world's largest economy, the most liquid financial markets on Earth, and over a century of institutional credibility. The way that credibility works traces back to a specific date, August 15, 1971. Before then, under the Bretton Woods system, every dollar was theoretically backed by a fixed quantity of gold. President Nixon ended that convertibility, shifting the dollar to a fiat currency, meaning its value is backed entirely by trust and government decree. Every major global currency made this same transition. Fiat money is specifically designed to lose value over time. It is a historical reality of the system, not a sign of imminent collapse. The primary institution responsible for managing this system is the Federal Reserve. The central bank operates with an official public mandate to target 2% annual inflation. Economists broadly agree this steady, modest inflation is necessary to encourage spending and prevent economic stagnation. Take a look at the math behind that target. At a consistent 2% annual loss, this curve illustrates how the purchasing power of your money is deliberately cut in half roughly every 36 years. This erosion is completely open. The Bureau of Labor Statistics publishes the exact rate of inflation every single month. The financial system isn't broken. It is working exactly as its architects intended. By policy, the system continuously erodes the value of static cash to force capital into active, productive markets. Millions of people are trying to build wealth the exact same way their grandparents did, by leaving cash in a standard bank account. That strategy ignores the basic rules of modern fiat currency. The first step to fixing this is logging into your bank account to find your annual percentage yield. If your APY is below the current inflation rate, you can confirm exactly how much purchasing power you are losing every month. This visualization compares where you park your emergency savings. Over 10 years, a $10,000 deposit in a traditional account earns about $428. Move that same money to a high-yield account, and it generates roughly $4,800. However, the interest earned in those accounts is taxable. After taxes, a high-yield return often just barely breaks even with inflation, meaning it preserves your wealth but does not grow it. To actually grow your wealth, you have to match your money to your timeline. Cash you need in the next year or two should stay liquid in checking or high-yield savings. But as this timeline shows, money you won't touch for 5 years or more requires a different vehicle. Assets like the S&P 500 or Treasury bonds are historically the most reliable mechanisms to generate returns that consistently outpace inflation over long periods. Inflation is the unavoidable operating system of modern finance. To protect your purchasing power, you have to stop expecting static cash to do the work of an active investment strategy.